Finance first, freedom follows. Welcome back to Finc Freedom. Here we are at beginning of 2024. Stock market crashed for 5 consecutive days, and many economic indicators show that the worst recession in U.S. history is coming. As we speak, we are experiencing the longest yield curve inversion since 1980. The indicator has consistently preceded each of the last 8 recessions without fail. Adding to these concerns, the Buffett indicator, the ratio of the total U.S. stock market to GDP, suggests a significant overvaluation in the stock market. The ratio currently stands at 175%, a stark 44% above the historical trend line. Concurrently, the Case-Shiller Home Price Index indicates that U.S. home prices are currently at an all-time high. What else is at record high level? Total credit card debt, a mouth-dropping 108 trillions. Yes, that's on a trillion level. While on the opposite side, U.S. household saving is depleting. According to the Federal Reserve, the excess savings accumulated by U.S. households during the pandemic are expected to drain out by the first quarter of 2024. After that, what is going to support the inflated food and shelter prices? Compounding these economic pressures are the frequent reports of layoffs in the tech sector, signifying a softening job market. While these data points do not guarantee an imminent recession, they certainly underscore the need for preparedness and prudence in financial planning. In the wise words of Warren Buffett, be fearful when others are greedy, and be greedy when others are fearful. Keeping this philosophy in mind, today's video will explore 7 strategic investments that can help you navigate and potentially benefit from an economic downturn. Remember to hit subscribe and join us on Finc Freedom for more insights on navigating through these turbulent financial times and on your journey towards financial freedom. 1. Investing in yourself. First and foremost, invest in yourself. Warren Buffett has always emphasized that the best investment you can make is in your own abilities. This is more than just acquiring new skills. It's about continuous self-improvement and adaptation. Enhancing your skills and knowledge can increase your employability and open doors to new opportunities. According to a LinkedIn survey, individuals who engaged in learning during the 2008 recession were 37% less likely to lose their jobs. During downturns, industries evolve and new sectors emerge. By staying ahead in learning, you can pivot and adapt, ensuring your career thrives regardless how the economy performs. Investing in yourself also means personal development, building resilience, and improving decision-making abilities. It's about understanding personal finance, investing, and market trends. The digital age has democratized learning. With online courses, webinars, and ebooks, you have the resources to enhance your knowledge right at your fingertips. Remember, by investing in yourself, you're not just preparing for the downturns, but also setting the stage for future prosperity. 2. The power of liquid cash. Having liquid cash during a recession is like having a lifeboat during a storm. It's not just an emergency fund, it's your financial flexibility in times of need. Personal finance experts usually suggest an emergency fund of 3-6 months expenses, but in a downturn, more may be better. This liquidity gives you the power to handle unexpected expenses without derailing your long-term financial plans. During the 2008 financial crisis, those with liquid reserves could manage the economic strain without resorting to high-interest loans. Furthermore, they were positioned to take advantage of lower asset prices, buying into markets and real estate at a discount. Cash reserves can be held in various forms: money market funds, short-term treasury bills, or high-yield savings accounts. Each offers different levels of accessibility and return. But the key is liquidity and safety. Also, cash reserves help you avoid the pitfall of selling long-term investments at a loss during market downturns. As John Maynard Keynes, a renowned economist, pointed out, markets can remain irrational longer than you can remain solvent. Therefore, having cash not only provides security, but also prevents forced financial moves in crazy times. 3. The stability of gold. Gold has stood the test of time as a reliable store of value. Since the gold standard was abandoned in 1971, fiat currencies like the US dollar have seen inflation, but gold has maintained its purchasing power. In fact, gold prices have seen an average annual increase of about 8%, demonstrating its role as a hedge against inflation. During economic downturns, gold often becomes a sanctuary for investors. For instance, in the 2008 crisis, gold prices saw a significant increase as investors sought stability amidst the market turmoil. This trend was not just a one-off, it's a pattern observed across various economic downturns. Moreover, gold's value isn't just in its price, but in its diversification benefit. It has a low to negative correlation with stocks and bonds, which means when traditional investments falter, gold often holds or increases its value. Gold can be invested in various forms: physical gold like coins or bars, gold ETFs, or gold mining stocks. Each has its own risk and return profile, but the underlying value remains the same. As JP Morgan famously said, "Gold is money, everything else is credit." In times of economic uncertainty, gold's stability can be a crucial part of a balanced investment portfolio. One more thing about physical gold that's worth mentioning here: it's physical gold's role as an insurance policy. This is partially the reason why physical gold usually require a markup over spot price. Historically, gold has been a go-to asset in tumultuous times, whether during economic downturns, wars, or political upheavals. Its value transcends national borders and economic systems, making it a universally recognized commodity. For instance, during World War II, gold often served as a means for refugees and displaced persons to secure safe passage or basic necessities in times when currencies were unstable or worthless. Gold's physical nature also offers a unique advantage. It's not reliant on digital systems or financial institutions. This makes it a robust form of wealth during systemic failures, where digital assets or bank-held wealth might become inaccessible. 4. The diverse benefits of other precious metals. In addition to gold, other precious metals like silver, platinum, and palladium also play a vital role during economic downturns. Each of these metals has unique industrial applications that can provide a buffer against recessionary pressures. Silver, often called the poor man's gold, has a dual role in both industry and investment. Its electrical conductivity makes it indispensable in electronics, solar panels, and new technologies. This industrial demand can sustain its value even as it serves as an affordable investment option compared to gold. During recessions, while investors turn to silver for its relative stability, manufacturers may continue to demand it for production, providing a two-pronged support for its price. Platinum and palladium are essential in automotive manufacturing, particularly in catalytic converters. Despite a recession, the transition to cleaner energy and emission standards continues, maintaining demand for these metals. Investing in platinum and palladium can be a strategic move, as they are rarer than gold and silver, which can lead to greater price appreciation when industrial demand picks up. Like gold, these precious metals can be held in physical form or through financial instruments like ETFs or mining stocks. While they can be more volatile than gold, they offer diversification and the potential for high returns. As economic conditions fluctuate, these metals' diverse applications can lead to unique investment opportunities. Incorporating a mix of precious metals into your investment portfolio can help mitigate risks and take advantage of the distinct advantages each metal offers. Just as a diversified portfolio is stronger, a mix of precious metals can provide a more resilient shield against the economic storms of a recession. 5. Embracing the future with education and e-learning platforms. As the job market becomes more competitive during a recession, the value of education surges. Warren Buffett himself is a proponent of lifelong learning, which is crucial for career progression. E-learning platforms and online education resources become a beacon for those looking to enhance their qualifications or pivot their careers. Investments in these platforms can capture the growing trend of remote learning and professional development. The demand for digital education tools and platforms has soared, as they offer flexible, cost-effective, and personalized learning experiences. Companies that provide these services may experience growth in user base and revenue, making them potentially strong investment contenders. By investing in the education sector, you're not just betting on individual companies, but on the driving force of knowledge in the global economy. 6. Building stability with infrastructure and public works. Infrastructure investments tend to be less volatile in economic downturns. They are often backed by long-term government contracts and can provide stable returns. During recessions, governments frequently increase spending on infrastructure to stimulate economic activity and create jobs. Companies involved in the construction, maintenance, and operation of infrastructure projects, such as highways, bridges, and public utilities, may benefit from this increased spending. By investing in infrastructure, you're tapping into a long-term growth narrative that is bolstered by the essential nature of these projects. Such investments can offer a hedge against recessions and provide a steady income through dividends or interest payments. They also have the potential for capital appreciation, as the assets are often in demand regardless of economic conditions. 7. Consistent investment in high-quality assets. Continuing to dollar-cost averaging in high-quality assets even during downturns. It is a fundamental principle of successful long-term investing. This strategy will pay off big when the market recovers. Instead of trying to time the market, focusing on regular investment in diversified, high-quality assets, whether it's gold, real estate in prime locations, or low-cost index funds, they can yield better returns over time. Economic downturns can present unique buying opportunities. Quality assets often become available at lower prices, offering a chance to build a robust portfolio at a discount. This approach requires patience and a long-term perspective, but the rewards can be substantial. For example, those who continued to invest in index funds during the 2008 downturn saw significant gains in the following years as the market recovered. Similarly, real estate investors who bought properties in prime locations during economic slumps benefited from appreciating property values over time. As we conclude our journey through the 7 investments everyone should make during a recession, let's reflect on the powerful insights we've gathered. From the wisdom of Warren Buffett to the practical steps of investing wisely during uncertain times, we've covered a wide range of strategies to not only survive, but thrive in a recession. We started by emphasizing the importance of investing in yourself, the most valuable asset you own. We explored the critical role of maintaining liquid cash reserves, the stability offered by gold, and the diverse benefits of other precious metals. The value of education and e-learning platforms was underscored as a forward-thinking investment, along with the resilience provided by infrastructure and public works. Finally, we delved into the significance of consistent investment in high-quality assets, highlighting the importance of a long-term perspective and the power of dollar-cost averaging. These strategies are not just about weathering economic downturns, but about seizing opportunities to build wealth. Remember, investing during a recession requires patience, insight, and the courage to make decisions that might go against the grain. It's about seeing beyond the immediate challenges and focusing on the potential for future growth and recovery. Keep working towards your financial goals and be kind to the others. If you found this video helpful, don't forget to like, subscribe, and share with others who might benefit. See you in the next video.